Ed, how low could prices go?
It's always hard to either say what the bottom is, what the top is, but we're figuring about a mid $60 price range for Brent, low $60 price range for WTI by the end of the year, just based on the numbers that we look at. And yes, there are wild cards in them that could change that one way or another, but mostly probably to the downside rather than the upside.
That's a big drop. I mean, that's not saying, okay, we're going to drop $5. You think we could go, if I'm roughly speaking here on U.S. oil, from almost 90 a barrel to something like 60? That's not a 50% drop, but maybe it's something like 30%.
Yeah, but we've lived in a volatile environment for a while. The last couple of years have been unusual, and this coming year is going to be unusual. We think most world analysts are wildly underestimating the amount of supply coming into the market this year. And we think we've done about as honest a job as we can, thinking about where those barrels are going to come from. Yes, there are two big wild cards. One is really on the bearish side, how much oil will Iran bring back to the market? And then in response to that, how much might OPEC Plus take out of the market? But the amount of oil coming just out of the non-OPEC countries is astonishing, and could be, excluding Russia and Kazakhstan, could be well over 2 million barrels a day.
So the heart of your argument is that supply is going to go up, prices go down. How do I play that trade if I want to follow your macro view there? Do I short oil contracts? Do I buy puts? What do I do?
Well, we think you go short the end of the year. Question is timing, and at what level do you do the investment on the forward curve itself, or do you do it on a level that's slightly below or above the forward curve? It would be safer to go short at a level slightly above the forward curve, but timing, I would wait a bit, because there are some very noisy things happening between now and the end of maybe February or March. We have to see how Ukraine plays out. It will have a denouement almost certainly before thaws set in. I think that's enough time to wait to see whether we have a spike up that might put a short trade under the water for the end of the year.
Ed, let me ask you about some of the bullish voices on oil, one of them being Goldman's Jeff Currie, who earlier this week said it's not just oil. He said we're running short of molecules. We're out of everything. We're out of oil and aluminum and you name it. We've seen, and we know this has been the strongest commodity recovery in history over the past 100 years or so. So the school of thought that sees all of these physical commodity prices going higher says there's just too much demand chasing the supply. Why is that view wrong?
Well, we take a different view of what surplus capacity is. We take a different view of how much oil is coming into the market this year and next year. I have no doubt that there is a lot of uncertainty about the impact of investments on the upstream side in the outer years of this decade. But I also have no doubt that people who are thinking that there's too little investment at work now are wildly underestimating the efficiency of capital and how much more can be bought in terms of new oil production, in terms of the drop in finding and development costs that we've seen. So we're taking a different view for the next 2 years, maybe for the rest of the decade, but I'm squeamish about the rest of the decade because we are in an energy transition, which could someday see supply coming in short on the basis of higher costs of capital and more restrictions on where people can spend money on oil and gas development. But I certainly don't see that, nor does anyone on our team on the equity side or the commodity side see that happening between now and the middle of the decade.